Hello, welcome everyone to Season 2 of the Financial Incline Podcast. I'm your host, John Bovard. So for this season, I will be sharing more solo episodes as well as episodes that I have with successful business owners, former athletes or current athletes, as they discuss how they've been able to win with their money. So first and foremost, the reason why I'm launching some more solo episodes is to share with you some of the insights that I've gained from working with successful business owners or younger high-income earners. So the first topic that I wanted to cover today is converting high income into lasting wealth, or better known as converting your high income into building financial freedom. So the reason that I wanted to talk about this today is a disproportionate number of Incline Wealth Advisor clients are either business owners or those earning anywhere from $350,000 annually and up. So when I sit down and I meet with a lot of those clients, one of their concerns is, okay, I have a good income. How do I want to make sure that this isn't just going to waste? That I'm building something that can create freedom from the standpoint of more time to do what I want to do, when I want to do it, and to who I want to do it with. So one of the ways to do that, I came out with an outline. It lists out 5 steps to where you can convert high income into lasting wealth. So step number 1 is you have to pay yourself first. So by paying yourself first, you're taking that money, your income, and you're immediately placing it into assets, whether that be through an investment account, through a Roth IRA account, put it into a business, maybe some rental real estate that you own. But you're taking that money, you're paying yourself first, knowing that down the road, that will start to pay off. So you're experiencing a little bit of delayed gratification. You're taking that money and you're getting that money invested. Then from there, then you can start to pay your bills, you can start to pay your mortgage, you can start to pay tuition, anything like that. But making sure that you have, first and foremost, paid yourself into your future to where you can enjoy that money down the road and where you can start to build and create freedom. So step number 1 is to pay yourself first. Typically, I think the best way to do that is taking 10%, maybe even as high as 20% of your income, putting that into an account where you know that you're going to get that invested and that will pay off for you in the long run. So step number 2 is to know your numbers. You have to know where you stand. This can be done pretty easily. You can make it as basic as an Excel sheet where you list out what are your assets, what are your liabilities or debt that you owe, and where do you stand today. You really want to figure out, okay, where is your net worth? Then when you know your numbers and you're starting to analyze those things, what can you be doing to grow your net worth? What can you be doing to maybe pay down debt? That can start to increase your net worth. Saving into an account and having that money work for you. Maybe your accounts have performed well last year. You're seeing a significant rate of return there. That can also look to increase your net worth. Maybe your real estate that you own, the value of that has started to go up. Or if you have any ownership in a business, hopefully that business is starting to appreciate and you're starting to see some growth there. But step number 2, you've got to figure out where you stand today. That's the only way that you could start to look forward and start to project out where you're going to be in the next 3, 5, 10, or 20 years. So step number 2, know your numbers. There are some easy apps that do this for you if you want to get a little bit more high tech. I have an app, I have a client portal that I use for my clients that they can track their net worth. There's apps like mint.com, Personal Capital. So a lot of places where you can actually track your net worth up to date in real time using an app. Or like I said, you can keep it as simple as an Excel sheet. But your numbers, like I'd mentioned, first and foremost, your assets. So those are your accounts, any assets that you own, whether that be real estate, 401ks, things like that. You can look at your liabilities. That includes your mortgage, includes any car loans, student loans, credit card debt. That would be included in your liabilities column. And then the other 2 numbers that you'll want to look at are your income. So how much do you have every single month that you're bringing home? And compare that to your expenses. So what are your average monthly expenses come out to. One of the ways I like to look at this is look at expenses at least over a 90-day period. You can even go as far out as a year and just see where you sit from an expenses standpoint and how does that compare to your income. So first thing you got to do, after you pay yourself first, know your numbers and know where you stand today. The third thing is you've got to get that money working for you. So some people refer to it as passive income. I simply refer to it as investing. Take that money that you have that's in cash, that income that you're earning, and put it into something that can grow while you're asleep. Something that is a passive activity that money is going to grow without you necessarily having to do anything. You move the money into that bucket, you get that money invested, and it starts to grow and compound for you over time. You'll be amazed at how quickly returns in an investment account can start to compound and add up for you over time, knowing that time is on your side. The rule of 72, it simply states that if you can average a 7% return over a 10-year period, that money should double. So getting your money invested so it's not sitting in cash in a checking or savings account. If you're thinking more long-term, you got to get that money invested and help that money to grow and hopefully start to double for you over time. The third step to consider is in helping to convert high income into lasting wealth is you've got to understand the tax consequences. So there's several different ways that you can look at taxes. There's several different ways that you can look at income. So first and foremost, look at your income from the standpoint of what is earned income, what is capital gains or investment income, and what is passive income. Are you receiving income in those three different buckets? If not, look to get a little bit of diversification in your income to where you can have earned income, you can get investment income, whether that be through capital gains or dividends. And the third bucket, which is a really involved and can be good for investors, is looking at that passive income bucket, whether that be through real estate or through money in an investment account. Really start to look and see how you can generate and be taxed on those three different types of income. Because the reason why I mentioned that, each one of those buckets of income has different tax consequences. Earned income being typically the highest that you'll pay in taxes. The next step down from there would be capital gains and dividend income is kind of the second highest. Passive income, you can receive some really good tax benefits by owning that. Taking tax consequences one step farther then, once you have the income, getting that invested in different types of accounts. So the three different buckets of money that you can look to invest in, and they each have three different tax consequences. So the first bucket of money is a pre-tax or traditional bucket of money. So typically you will see this within your company 401k plan, maybe a 403b plan, or a deferred compensation plan. So what that money does is it's money that you defer from your income now. It's not taxed. Then later on down the road, when you start to pull that money out, it becomes taxable at that time. So like I'd mentioned, 401k plan is good for this. So you'll want to understand where your money is going and what type of account you will be saving into. Because what you need to realize is down the road, as you start to take that money out, you may not be in a lower tax bracket once you enter retirement. The second bucket of money to look at is a Roth bucket of money. So that could be either a Roth 401k or a Roth IRA. And this is really the sweet spot in savings, and later on down the road, as you get into retirement, it can be a great account to pull money from, because as long as you have that money, the Roth account has been open for at least 5 years, you're over 59 and a half, you can take a qualified distribution from a Roth IRA and you would not pay any taxes on that money. So the way a Roth IRA works, that money is taxed up front. You put that money into a Roth, you get it invested. Then later on down the road, if you take a qualified distribution from that Roth IRA, the money you put in plus the investment growth can all be withdrawn completely tax-free to you. So this can be a great strategy for when you start to pull money out of your accounts and it can keep you in a lower tax bracket all throughout retirement, which can then give you another tax-free bucket, which would be your Social Security income. If your income is low enough, you can pull money from a Roth IRA, you can pull money from Social Security, and as long as you pull under the standard deduction amount from your pre-tax account, that would also be looked at as a tax-free income that you can have in retirement. So second bucket of money, one of my favorites is a Roth IRA. You know it's a good thing when they try to limit the amount that you can put into a Roth IRA. A Roth IRA has contribution limits. If you're under 50, it's $6,000 a year. Also, if you're above a certain income threshold, you can't contribute at all to a Roth IRA unless you make a backdoor Roth contribution. Then the third bucket of money is referred to as your taxable bucket of money. So this is after-tax money that's you've already paid taxes on. It may be sitting in a savings account or a checking account. And that money works from a capital gains perspective. So the money that you put and the money that you get invested, that is your principal balance. If that money were to grow and you held those investments for longer than a year, if you were to sell off your gains, you would pay capital gains tax on that. This is advantageous because the capital gains tax rate typically falls either 10, 15, or 20%. And that amount will be lower than your earned income tax rate, so money that you're pulling out from your pre-tax accounts. Your account in your brokerage account or taxable account, that money will be taxed at a lower rate, a lower capital gains tax rate. And most of the time your dividends, if they're qualified dividends, will be taxed at a lower rate as well. So these accounts can be good because they're more flexible. If you have shorter term goals, goals that, if you need the money before retirement age, before those rules on IRAs is up, like age 59 and a half. If you have more short-term goals, such as maybe buying a new house, buying a vacation home, purchasing a business, purchasing investment real estate, then saving your money into a brokerage account is a good option for that. And lastly, step 5, it is to convert your earned income into passive income. And the way to do that is by owning assets. So to truly generate significant long-term wealth, you have to own businesses or you have to own real estate. You've got to own assets. And an asset is something that has the opportunity to appreciate in value and also provide income to you, put money into your pocket every single month. So I named a few of these. If you own equity in a business, if you own investment real estate, or if you own high dividend paying stocks, if you own royalties, licenses, any of those are assets that you own that could put money into your pocket. And when I say owning assets, you can do that as simple as buying stocks in valuable companies, so big blue chip companies, or you could get lucky and find a growth or technology company that really takes off in value. But you have to own assets. You simply cannot save your way into financial freedom. You've got to get that money working for you, and you've got to own assets. So once you have the basic boxes checked, you've got enough saved for retirement. I typically suggest anywhere from 15% per individual saved towards retirement every year. And you've got your debt paid off, so no bad debt, no credit card debt, student loan debt. Then you look to start to owning assets. And like I said, these could be commercial real estate, could be residential real estate. It could be as simple as buying individual stocks as well, or putting money into an index fund that will own that stock for you, and it'll be a little bit more diversified. Or if you're lucky enough and the situation presents itself, maybe you can find a couple of private businesses that are in your area that you can look to invest in. Maybe act as the board of advisors or look to invest in that, because over the long term, and statistics show that business owners can truly generate life-changing wealth and generational type wealth, either through owning equity or owning that at individual or private business directly. And that can be money that can change the course of not only your life, but your kids and your grandkids' lives. So I'll be sharing more information about this over the coming weeks, but wanted to get this video out, get this episode out to let you know these are those 5 steps that you can take to converting high income now into lasting wealth and into financial freedom. So like I said, I'll be doing a deeper dive on each one of these topics in the coming weeks. I wanted to share this information with you today. Hope you liked it. Hit the subscribe button and look forward to sharing future videos.